Spotify's stock dropped 14% yesterday after it reported a quarterly loss of €300 million. This was more than double the $125 million loss it made 1 year ago. At the latest share price, the company now has a market cap of $29 billion. It's got $4.9 billion of cash and investments and $1.3 billion of debt, so the enterprise value is roughly $25 billion. Taking into account the latest quarter, Spotify has made a net loss of almost €1 billion over the last 12 months. 410 million of that is coming from stock-based compensation. Free cash flow has also dropped substantially, from 280 million in 2021 to just 28 million over the last 12 months. There are two key reasons for this poor performance. First, Spotify pays out a lot of money to music labels. This means the company has low gross margins of only 25%, and its gross margins have also declined by roughly 1% since 2018. Second, Spotify has continued to spend money developing its platform. It's been investing heavily in podcasts, advertising, and AI, famously paying Joe Rogan an alleged $200 million. The foray into podcasts has been a mixed bag, with the company axing a number of them over the last year. Advertising also hasn't been going that well. Ad revenue has been increasing, but the profit contribution, shown in green, is barely visible on this quarterly chart. The good news, however, is that Spotify is still seeing significant growth. Total monthly users increased 27% year over year to 551 million, with a 17% increase in premium subscribers. As a result, total revenue increased 11% year over year, taking the total to 12.4 billion over the last 12 months. And this continues an excellent record of consistent revenue growth. Investors don't like Spotify's gross margins, but the company does have plans to fix this. Last week, it announced a $1 price increase, taking the monthly subscription price in the US to $11 a month. Audiobooks could also be a lucrative avenue for Spotify, with CEO Daniel Ek saying that they could become very, very big. Let's assume Spotify can get to 20 billion in revenues by 2028 and get its net income margin to 10%. That would see the company producing 2 billion in earnings in 5 years' time, and a 25 times multiple would put the company at a valuation of 50 billion. That works out to an investment return of almost 14% a year. The thing is, Spotify could do better than that. $11 a month for unlimited music is still incredibly good value, and that gives the company plenty of room to raise prices even further. All that said, the music industry is undergoing rapid changes right now with the development of AI. It's difficult to know how that's going to play out, and the biggest risk to Spotify could well be TikTok, which recently announced its own platform, TikTok Music. Overall, $25 billion for the world's premier music platform doesn't seem unreasonable. The threat from TikTok needs to be watched closely, but right now I give Spotify a bullish rating, but these are my personal opinions, not financial advice, and I do hold shares in the company. For more detailed investing ideas, make sure to visit our website overlookedalpha.com.